You know that feeling when you look at your investment portfolio and you're not even sure if you're doing this right anymore? Like, you've got some money in index funds because that's what everyone says to do, maybe a little crypto because your cousin would shut up about it, and now you're seeing headlines about AI stocks and quantum computing, and you're thinking, am I missing something huge here, or am I about to make a massive mistake chasing the next shiny thing? Yeah, that's where most people are right now. And honestly, both feelings are completely valid. My name is Tom, and I spend way too much time thinking about where the smart money is actually going in 2026. If you're someone who wants to build real wealth, but you're tired of getting whiplash from every new investment trend that pops up on your timeline, hit subscribe and give this video a thumbs up because we're going to cut through the noise and talk about the 5 investment trends that actually matter this year, and more importantly, how to think about them without losing your mind or your money. Here's the thing that nobody wants to admit. Investing in 2026 feels different than it did even 2 years ago. The old playbook of just dump everything in an S&P 500 index fund and forget about it still works for most people, and I'm not saying it doesn't, but there are genuine structural shifts happening in the economy right now that are creating opportunities that didn't exist before. And if you ignore them completely, you might be leaving significant money on the table. But here's what most people don't realize. The biggest risk isn't missing out on the next big trend. The biggest risk is abandoning a solid long-term strategy to chase something you don't understand just because you're afraid of being left behind. I see this constantly. Someone has a perfectly good portfolio that's been growing steadily, and then they read one article about some new sector, and suddenly they're liquidating everything to go all in on something they learned about 15 minutes ago. So, we're going to talk about these trends the right way. We're going to look at the actual data. We're going to understand the psychology behind why these trends matter, and then we're going to figure out how to actually incorporate them into your portfolio without doing something stupid. Let's start with trend number 1, and this is the one that's been absolutely dominating the conversation: artificial intelligence infrastructure. Now look, I know what you're thinking. AI? Tom, we've been hearing about AI for like 3 years now. Isn't this old news? And yes, you're right that AI itself isn't new, but here's where it gets interesting. We're transitioning from the hype phase to the infrastructure phase, and that changes everything. Think about the internet boom. The first wave was all these crazy dot-com companies that had no business model. Most of them failed spectacularly. But you know who made massive money during the internet boom? The companies building the infrastructure. The fiber optic cable manufacturers, the server companies, the semiconductor firms. Cisco, not Pets.com. We're at that exact moment with AI right now. According to Goldman Sachs, global spending on AI infrastructure is projected to hit $200 billion in 2026, and that number is expected to triple by 2030. We're talking about data centers, specialized chips, power infrastructure, cooling systems, networking equipment. This isn't speculative anymore. These are real companies with real revenue solving real problems. Here's a stat that blew my mind. A single AI training run for a large language model can consume as much electricity as 100 homes use an entire year. Microsoft and Google are literally signing deals to restart decommissioned nuclear plants just to power their AI data centers. This is happening right now. So, what does this mean for your portfolio? It means that instead of trying to pick which AI software company is going to be the winner, you can invest in the infrastructure that all of them need to function. Whether ChatGPT wins, or Google's Gemini wins, or some company we've never heard of wins, they all need the same basic infrastructure to operate. Now you might be thinking, okay, but aren't these stocks already expensive? Haven't I already missed it? And that's a fair question. Some of the most obvious plays, yeah, they've run up. But here's the psychological trap that gets people. They see a stock that's up 80% in the last year, and they think they missed it. But if a company is going to 10x over the next decade, being up 80% in year 1 just means you're getting in at the beginning of year 2. You're not late, you're early to the middle. The key is distinguishing between companies riding on hype and companies with actual growing revenue from this trend. Look at their earnings reports. Look at their infrastructure contracts. If a company is saying, "We're exploring AI applications," that's hype. If they're reporting, "We delivered 47% more data center chips this quarter than last quarter," that's revenue. Trend number 2 is something that sounds boring but is absolutely printing money for people who understand it: private credit. Now look, I get it. Private credit doesn't have the sexy factor of AI stocks or crypto, But here's what most people don't realize. This market has grown from about $500 billion in 2015 to over $1.7 trillion today, and it's projected to hit $2.8 trillion by 2028. Here's what private credit actually is. It's loans made by non-bank lenders to companies and individuals. Think about it this way. After 2008, banks got hit with massive regulations that made it harder for them to make certain types of loans. But companies still needed money. So private credit funds stepped in to fill that gap, and they can charge higher interest rates because they're taking on the risk that banks don't want. Right now, with interest rates where they are, private credit funds are regularly generating returns in the 9 to 12% range. And these aren't speculative returns based on some company's stock going up. These are contractual interest payments from borrowers who need capital. Here's the catch, and this is where the psychology gets interesting. Most private credit investments require you to be an accredited investor, which means you need either a net worth over $1 million excluding your primary residence or an income over $200,000 a year. This is one of those things where the rich do really have access to better investment vehicles. But, and this is important, that's changing. More platforms are opening up private credit access to regular investors, and more publicly traded funds are focusing on private credit strategies. You can actually get exposure to this without being a millionaire. The reason I'm bringing this up isn't to depress you if you're not an accredited investor yet, it's to show you where capital is actually flowing. Institutional investors, the people managing billions of dollars with teams of analysts, they're pouring money into private credit right now. And when the smart money is consistently moving in one direction, it's worth paying attention. Trend number 3 is infrastructure. And I'm not just talking about boring municipal bonds, I'm talking about the massive rebuild of physical and digital infrastructure that's happening across developed economies right now. The Infrastructure Investment and Jobs Act in the US alone is $1.2 trillion over 10 years. Europe has similar massive infrastructure programs. These are multi-decade investment cycles. Here's a stat that should wake you up. The American Civil Engineering Society estimates that the U.S. has a $2.59 trillion infrastructure funding gap over the next decade. That's the difference between what we need to spend and what we're currently planning to spend. And that gap represents opportunity. We're talking about everything from electrical grid modernization to water systems to bridges to broadband expansion. And here's where it gets interesting from an investment perspective. A lot of this isn't being built by traditional government contractors anymore. It's public-private partnerships, which means publicly traded companies are getting massive long-term contracts with guaranteed revenue. But the real opportunity that most people are missing is the intersection of infrastructure and technology. Smart cities, electric vehicle charging networks, grid-scale battery storage. These aren't 20-year-away technologies. These are being built right now, and the companies building them are growing revenue at 30, 40, 50% a year. Think about EV charging infrastructure specifically. Right now, there are about 4 million electric vehicles on U.S. roads. That number is projected to hit 30 million by 2030. Every single one of those cars needs somewhere to charge. That's not speculation about whether a technology will catch on. That's basic math about infrastructure that needs to exist. Now you might be thinking, Tom, infrastructure sounds stable, but it also sounds like slow growth. I'm young, I want growth. And I get that. But here's what's fascinating about this trend. You can find infrastructure companies growing as fast as tech companies, but with way more predictable revenue because they have long-term government contracts. You're getting growth without the same level of risk. Trend number 5 is going to surprise some people, but I have to talk about it because the numbers are undeniable. Tokenization of real-world assets. Notice I didn't say crypto, I didn't say Bitcoin, I said tokenization, and there's a massive difference. Here's what tokenization actually means. Taking real assets, things like real estate, bonds, private equity, art, commodities, and representing ownership of them with digital tokens on a blockchain. This allows fractional ownership, 24/7 trading, and way lower transaction costs. Now, look, I know blockchain and crypto have been associated with scams and volatility and people losing their life savings on meme coins. All of that is real, and all of that is stupid. But here's what most people don't realize. While retail investors were gambling on dog-teamed coins, major financial institutions have been quietly building infrastructure for real assets. BlackRock, the largest asset manager in the world, launched a tokenized money market fund. JP Morgan processes billions in tokenized repo transactions. The Hong Kong Monetary Authority is piloting tokenized bonds. This isn't speculative anymore. This is the plumbing of the financial system being upgraded. Here's why it matters. Right now, if you want to invest in commercial real estate, you either need millions of dollars to buy a property, or you buy a REIT, which is basically a company that owns properties. With tokenization, you could potentially own a fraction of a specific building in Manhattan for a few $1,000s, trade it 24/7, and get direct income from rent. According to Boston Consulting Group, the tokenized asset market could reach $16 trillion by 2030. That's not a typo. Trillion with a T. And right now, it's maybe $300 billion. This is a 50x growth opportunity, if it plays out the way institutional investors think it will. The risk, and this is real, is that this technology is still early. The regulation